Goldman and Deutsche Bank seemingly concurred and put out their own pricing upgrades for oil. Markets are facing a sustained supply shock driven by Hormuz disruptions. Let that sink in. Enforcement actions and delayed recovery timelines, record inventory draws, and tightening conditions. Despite soft demand, while limited supply responses keeps the market undersupplied, price risks are skewed higher, with forecasts rise and upside scenarios pointing to significantly elevated oil prices. Ladies and gentlemen, the global oil market is shifting from disruption to a cumulative supply shock. What began as a localized bottleneck around the Strait of Hormuz has evolved into a layered constraint system involving reduced flows, active enforcement, and delayed recovery timelines. The result is going to be a tightening supply profile that is overwhelmingly baseline and forcing a repricing of risk. With analysts on the street and from Deutsche Bank and Goldman Sachs, they're converging on 3 points. One, disruption is intensifying, normalization is being priced out and pushed out, and price outcomes are skewing higher. Ladies and gentlemen, the system's absorbing a shock that's both larger and more persistent than initially assumed, again. So when you look at supply disruptions and that becomes structural, that becomes the new norm, this is what we're talking about always.